Singapore's central bank says the country's rising household debt is worrying and that it's important to act now to limit the build-up of leverage. The warning came as the Monetary Authority of Singapore delivered its annual report.
Property prices in Singapore have been climbing, spurred in part by the low interest rate environment. And as loan tenures stretch, the MAS is concerned that households in Singapore could have overextended themselves.
The vast majority of mortgage loans in Singapore are on floating rate packages, which means households will face higher monthly repayments when interest rates normalise.
According to the MAS, up to 10% of borrowers in Singapore have probably over-leveraged on their property purchases. And if mortgage rates were to rise by 3 percentage points from current levels, this could increase to 15%. There are expectations that global interest rates would start to climb, with the US Federal Reserve signaling that it might soon start to tighten on liquidity. The MAS warns that lower-income households and those with lesser savings could be strained if mortgage rates rise. Already, the MAS has started to act against this risk. Last month, it tightened regulations on home loans to encourage financial prudence and cool speculative demand. Over the past 3 years, housing loans by the banks rose by 18% annually. And as a percentage of gross domestic product, home loans now stand at 46%, up from 35% 3 years ago.
For the overall economy, the MAS expects GDP growth to meet official targets this year.
The economy will comfortably meet the growth forecast of 1 to 3% for 2013. Growth was estimated at 2% for the first half of this year and should pick up further in the second half.
The MAS expects inflation this year to come in at 2 to 3%. That's down from the previous forecast of 3 to 4%. Numbers out today show that inflation climbed 1.8% in June compared to the previous year. It was driven by rising petrol pump prices. But for the first half of the year, inflation for households came in at 2.8%, down from 4.1% in the previous 6 months.